Hi everyone, this is John Rothe, and I am the portfolio manager of the Arteas Fund and owner of the Rothe Financial Group, a registered investment advisor here in Virginia. And welcome to my September podcast of Markets in 4. Today I'm trying something a bit new. I'm converting the Markets in 4 podcast into a video format. Personally, I find presentations much easier to follow if there are visuals. Hopefully you'll agree with that. So let's start out by reviewing what's been going on in the stock market since my last update. Over the past 2 weeks, the U.S. stock market has taken a very sudden decline due to fears that European banks may be somewhat underfunded. Continued fears of a Greek default is making the situation even worse, and now there's even talk that defaults in other European countries may cause the euro to eventually collapse. This, of course, would have a huge impact on an already fragile global economy. Now, while U.S. stocks took a hit with the news, it should be noted that U.S. stocks have been stuck in a trading pattern since the beginning of August. Here at home, continued fears of a double-dip recession have kept the markets volatile and without direction. However, the markets have remained orderly. The markets declined to the same technical levels that have kept the markets in this pattern. Now, one popular tool I want to quickly discuss is one that traders love to look at, which are called Fibonacci levels. Now, the Fibonacci sequence is named after Leonardo of Pisa, who was also known as Fibonacci. Fibonacci's 13th century book was when he first introduced the sequence to Western mathematics. Now today, many technical traders use these numbers to help identify strategic places for buy or sell orders to be placed, or for target prices or where to place stop orders. Now in this case, we can see that the S&P moved downward to a Fibonacci level. The market then reversed back upward at this level, continuing the current trading pattern. As this sideways trading pattern continues, I'm going to be waiting to see if the market can break above this pattern in the upcoming weeks. Now, investors may want to start looking for opportunity in the market, as remember, historically October is where numerous market bottoms have occurred. Now, as for gold, this has been a hot topic in the financial media heads this week. Many are wondering if the gold bubble is over. Well, I don't think it is yet. Gold, which is usually viewed as a flight to safety asset group, declined last week along with the rest of the market. However, most of the decline can be attributed to margin calls from leveraged investors. Now, behavioral finance has taught us that investors typically sell winners first to pay for their losing trades. And frankly, gold has been the winner of late. Now again, looking at the charts, gold seems to be stuck in a similar pattern as the S&P 500. However, if you do take a look at the weekly chart of gold, we can see a longer-term trend is still upward. And we may just be seeing some sort of profit taking as well as from gold as being so overbought in the short term. Now, one area to be careful with, I think, is the U.S. bond market. Bonds shot up as the Fed announced Operation Twist last week. Now, for those who are not familiar, Operation Twist is designed to reallocate the Fed's bond portfolio from short-term bonds to long-term bonds. The idea is that by doing this, longer-term interest rates will come down. The Fed is hoping that this is going to help the housing market and will spur investment expansion by offering super low long-term rates. My concerns with this plan, however, is that many homeowners are still underwater and will not be able to take advantage of lowered mortgage rates. And many businesses are already sitting on record amounts of cash and are just not expanding due to fears of either slower recovery, unknown future tax rates, and in some industries are seeing increased future regulation. Now, a bigger concern in the bond area is that many unsavvy investors are flocking to bond funds for safety and because of the recent positive rates of return. Many of these investors are near retirement and unaware of how bond prices will decline once rates start to rise. This could possibly wipe out investors hoping to retire in the near future. So please, if you're investing in bond funds, make sure you understand how they work. Well, that's it for this week. Please remember to check out my blog, Musings of a Money Manager, at johnrothe.com for daily market updates. And thanks for watching,